In this video, we're going to discuss strike prices and how to understand the different types. The options world consists of three different types of strike prices: ATM, otherwise known as at the money, ITM, or in the money, and OTM, out of the money. At the money, in the money, and out of the money are the three different types of strike prices that you can choose from. Let's discuss at the money. An at the money option consists of a strike price that is approximately equal to the current market price of the underlying asset. In other words, an at the money option is when the option strike price is very close to the stock price. Let's look at a strike price example. Let's say the current stock price is near $100. A strike price of $100 will be considered at the money. An at the money call option will have a delta of roughly 0.5, while an at the money put option will have a delta of roughly negative 0.5. All of the value in an at the money option contract will be extrinsic, meaning that all of its value is made up of mostly time and volatility. At expiration, a at the money strike price may be auto-exercised, due to the fact that an at the money strike price is close to the current stock price. This means that an at the money contract teeters on the line between in the money and out of the money, meaning that they could fall in the money at any moment, which puts them at risk for being auto-exercised. Because of this, it is highly advised that you pay attention to your at the money contracts at expiration. Let's take a look at an option chain to see where we'll find an at the money contract. In this example, you'll notice the last sale price of Apple was $167.23. An at the money strike price will be the same for both calls and puts. In this scenario, the at the money strike price will be $167.50. This is because it's the closest to the underlying asset at $167.23. Let's now take a look at in the money contracts. An in the money option consists of a strike price below for call options or above for put options the current market price of the underlying asset. In other words, this strike price is where the option has intrinsic value and could be exercised profitably at its current price. Let's take a look at an example. Let's say that the current stock price is $100. A call contract that is in the money will be at $99 and below. A put contract that is in the money will be at $101 and above. The call delta for an option that is in the money will be greater than 0.5, while the put delta for an option that is in the money will be less than negative 0.5. In the money option contracts hold both intrinsic and extrinsic value. And because of the intrinsic value, at expiration, these contracts will be auto-exercised. Let's revisit the option chain. You'll recall that the underlying asset has a value of $167.23. This means that a call contract under that price of $167.23 will be considered in the money. On the other side, all put contracts above $167.23 will be considered in the money. Take note that in the money does not necessarily mean that your P&L is in the money. In the money simply describes the location of the call or put option contracts that you're holding for the underlying asset. Our last one is out of the money. An out of the money option consists of a strike price above for call options or below for put options the current market price of the underlying asset. In other words, this is an option contract with a strike price that has no intrinsic value. Therefore, it cannot be exercised profitably at its current price. Let's take a look at an example. The current stock price is $100. A call option with a strike price of $101 and above will be considered out of the money, whereas an out of the money put contract will be at $99 and below. The call delta for an out of the money contract will be less than 0.5, and the put delta for an out of the money contract will be greater than negative 0.5. The value held in these contracts is only extrinsic. Therefore, at expiration, they are not auto-exercised. Let's revisit the option chain. You'll remember that the stock price is currently sitting at $167.23. Call contracts above the current stock price will be considered out of the money. Therefore, in this scenario, contracts starting at $170 and above will be considered out of the money, whereas put contracts will be considered out of the money when they fall below the current stock price. In this scenario, the 165 strike price and below will be considered out of the money. You should now have an understanding of the three different types of strike prices, where they sit on your options chain, what type of value they hold, and whether they will be auto-exercised at expiration. Each of these option strike types, at the money, in the money, out of the money, has its place in the options world. It's up to you how to use them in your strategy going forward.